Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourself, Banking and General Knowledge, etc. Today I will talk about bank merger or bank privatization. Today I want to share my perspective on the recent signals around banking reforms. Instead of focusing on headlines or speculation, I am looking at the timing and structure of policy decisions to understand why consolidation appears to be taking precedence over ownership change. Why merger comes before privatization? A policy perspective. At certain moments in a nation's economic cycle, reform does not arrive suddenly. It unfolds in stages, measured, deliberate, and structured. The recent signal to review banking reforms through a high-level mechanism reflects such a phase. Rather than announcing immediate ownership change, policy has chosen assessment, alignment, and internal strengthening. This choice itself reveals direction. Reform begins with readiness. Public banking institutions do not operate only for profit. They stabilize credit, absorb economic stress, and support long-term development. When reform timing favors caution over speed, policy naturally prioritizes strengthening existing structures instead of transferring ownership. In this phase, the objective is not exist, but resilience. This is where merger becomes relevant. While merger fits this phase, consolidation improves scale, governance, and capital efficiency without disturbing institutional continuity. It corrects structural weaknesses while preserving public accountability and depositor confidence. Merger allows reform within the system rather than reform away from the system. Such an approach aligns with periods when stability is valued more than disruption. The role of review mechanisms. High-level review bodies typically emerge when policy direction is clear, but sequencing matters. At this stage, focus remains on rationalizing overlapping operations, improving capital deployment, strengthening governance frameworks, enhancing operational efficiency. These are consolidation objectives, not divestment signals. If privatization were imminent, urgency, valuation, and timelines would dominate the discourse. Instead, the language remains procedural and institutional. Merger as a transition tool. During such reform cycles, mergers serve three critical purposes. First, they absorb risk without creating market anxiety. Second, they deliver scale without ownership shock. Third, they test the system's ability to manage complex reform. Successful consolidation signals preparedness for deeper changes in the future. Why privatization waits? Ownership transfer is irreversible. It requires a system that is already streamlined, resilient, and insulated from transition risk. The current reform rhythm suggests preparation, not finality. This does not eliminate privatization as a future option. It simply places it later in the sequence. The direction is clear. The emphasis today is on alignment before exposure, strength before transition, structure before sale. In such timing, merger is the natural policy instrument. Conclusion. Reform cycles move in stages. First, systems are stabilized, then they are consolidated. Only after that are irreversible decisions considered. Interpreted through timing and policy rhythm, the present phase clearly favors merger over privatization, not as an alternative, but as a prerequisite. Disclaimer. This video reflects my personal views and interpretations, meant purely for discussions and understanding. It should not be taken as policy advice or a prediction. Thank you very much for your patience. Request for like, subscribe, and share.